So currently it's just 10 o'clock and it would be time to start the webinar. We only have 65 participants from 202, but I think we should start anyway because we only have 2 hours time and we have actually 3 very interesting presentations we should be able to go through. So welcome to the webinar. Actually, it's the first one from the Risk Management Committee. My name is Frank Schiller. I'm the moderator. I am the vice chair. And with me is Malcolm Kemp. He's the chairperson of the AAE Risk Management Committee, and Christoph Kischenitz. And I want to briefly share with you the agenda for today's webinar. So we will start, or actually not we, but Malcolm and Christoph will start with giving you an overview of actuaries and operational risk management. Second topic will be the Solvency II risk margin, a very current and new paper. And then finally, I will give you an update on the current status of EIOPA's view on macroprudential framework. The idea is that after each of these presentations, they will have like 30 minutes duration, that we have 10 minutes time to answer your questions. So when you have during the presentations, one of the 3 presentations, when you have any questions, please use the chat functionality. So I think Susanne showed you where this is. And well, by the way, if you have any questions, any problems, issues, Susanne from the AAE can and will support you during the webinar. So when you have questions concerning the presentations, please use the chat functionality, as all of you are on mute and only the moderators are unmuted. And I will take these questions up in the last 10 minutes. We will have time to answer your questions. So then I'm happy to give the word to Malcolm. Malcolm, you're here already?
I am, yes, you can hear me.
Excellent. So then I'm happy to briefly introduce Malcolm as the first speaker. As I said before, Malcolm is the chairperson of the AAE Risk Management Committee, and he will start presenting on actuaries and operational risk management. And I will start sharing his screen for you. So when I find Malcolm, here he is.
Brilliant. Can you see my screen?
Yes, I can see it.
Brilliant. Okay, well, welcome everybody. Good morning. What I want to do this morning is just to introduce a paper that several of us have put together on actuaries and risk management. And Christoph, one of the co-authors of the paper, is going to focus on most of the contents. But just to give you a little bit of a background, we've got information about myself and Christoph, and what we're going to try and cover this morning is a little bit about, I'll try and set the scene, and then, as I said, Christoph will move into looking at operational risk management disciplines and techniques, why we think actuaries are particularly relevant in the operational risk space, and then if we have time to run through some of the material covered in the appendices to the paper. You've got a link to the paper. If you haven't already had a chance to review it, please feel free to do so. But we're going to try and give you an overview of its contents in this presentation. So if I can just explain a little bit more about the paper and where it came from. The AAE's Risk Management Committee is one of the core committees that the Actuarial Association of Europe has, and it's very keen to ensure that actuaries are well regarded, able to contribute to policy debates, etc., in the risk management area. And that means that it covers all sorts of different types of risk management, but this paper focuses just on operational risk management. Most of the paper is focusing on insurers or pension funds, but some of the content is broader. Operational risk disciplines are, well, operational risk is not unique to these types of entities, and the disciplines that are applicable in many cases can be reused, maybe adapted in some ways for different institutional types. We've tried within the paper to provide quite a bit of insight and thought and detail in different areas. So the kind of the theory behind the paper was that we would endeavour to identify the main roles that operational risk managers might facilitate, do in their day-to-day job, and we would try and comment on as many as possible of those, bringing out some of the benefits of the actuarial skill set, but also some of the lessons that are available from elsewhere within the insurance and pension fund world, but as I said, also outside the insurance and pension fund world. So I've set up on the slide 7 just the main roles of an operational risk manager as we typically see them. The risk manager will identify the context, and that's going to differ according to the institution, but also according to the institutional type. Many risk managers will have an important role in coordinating the risk management activities. The responsibility will lie with the board, but often they will want to delegate the day-to-day coordination to someone, either risk manager. And then when the risk management function tries to kind of address and coordinate that, there'll be a variety of activities like gathering information, carrying out workshops, modeling the information, often modeling the information. There's relatively limited amount of data, but ignoring the data that is available is usually less than optimal. And then there'll be usually further analyses about what might happen if the world changes, stress testing, scenario analysis. But all of that is to do with analysis, and it might provide useful information for boards, but it's important for the business as a whole to implement an effective process that will actually deliver a robust operational risk framework. So there's an important role in setting and monitoring limits and key risk indicators, etc. And unless that's all communicated well, usually the operational risk function will not deliver optimally. So as I said, the paper endeavours to explore, not in huge amount of detail, all of those subjects, given that it's a pretty broad spread of topics. And now I want to hand over to Christoph to delve into some more of the principles and also some more of the details contained in the paper. So I'll see if I can change the presenter. To Christoph.
Hello, good morning, everybody. Can you hear me? I think I have now the task to show you a little bit the contents of the paper. Operational risk management is not very common among actuaries, and so we thought it's good to show that with actuarial techniques and methods we have learned in other disciplines, we are very good prepared also to doing operational risk management. First question arises, what is operational risk management really? If you look on companies outside the financial world, then almost everything is operational there. They have their production processes, they have their research processes, their selling and buying processes, and that is very operational. But within the financial sector, the operational risk is a little bit different from the main business risk in insurance, pensions, or banking, because a lot of risks there is coming from the outside world, from markets outside the company, and is not so much related to the internal processes and structures of the company. So EIOPA gave a definition of operational risk within the financial sector as the risk of loss arising from inadequate or failed internal processes, people, and systems, or from external events, namely some cyber risks coming from outside, natural catastrophes coming from outside. So it's you can say it's also some risk of, for instance, business interruption or something like that. Risks insurance companies are able to cover for other companies, but this is now the risk the insurance companies cover themselves. Another way of seeing operational risk is the way that we can say that the risk that is not unrewarded. Insurance risk, financial risk, if it's taken to the company, then we get some reward for them, a risk premium or something like that. But operational risk you face without having any reward on them, without having any premium on them. That means operational risk is mainly a downside risk. You cannot make a gain, you can just reduce eventual losses on that. But of course, as I said already, operational risk is also something insurance offers as a coverage for other industries. What are the typical tasks on the agenda of a operational risk manager? So that's it's not so different from a normal, so to say, a normal risk manager, enterprise risk manager. Operational risk is just one discipline of that. But it's important to see what is necessary to do and which skill set is then necessary to have for this. So one thing is the formulating and implementing a coherent and effective risk management process. So there are two things in this line. First, the formulating of a risk management process. That means a strong communication to the management, to the senior level of the company, to get commitment for that and to get a common understanding of risk management. So communication to the management is here important. And the second thing is the implementing of the effective risk management process. This is to have good ideas about the processes, about the guidelines within the company. That is to communicate to the lower level management and to the staff, to the people in the company, to explain and make them aware of these processes and the requirements we have here. So it's a communication as well to the management as well to the member of the company. You always have to championing risk management with the senior executives and board. You always have to challenge them, and you always have to explain, and you always have to discuss this, which means you must have also a senior level, a senior role in the company to have an eye-to-eye discussion here on this risk topics. Similar thing is challenging from a risk management perspective, the activities and decision making of others within the organization. You will not get friends out of this task, but you always have to do a little bit of controlling and monitoring others' processes. You always have to make them aware of possible failures of risk and so on, and always have to challenge their decisions. How did you come to this decision, and why did you take this decision, and did you realize the consequences out of this decision? Then a more formal work to do, drafting and updating risk policies, a lot of writing, which means you have to keep the writing short but understandable, which is not an easy task always to do. The more mathematical point of view is developing and implementing ways to measure and manage operational risk. You can only manage if you have a measure for that. So these measurements and these models which we need for operational risk management have to be developed and implemented in the IT systems and so on. Controls, to formulate implementing controls, it's a not so easy task. So mathematically spoken, you have to do some principal component analysis in some sense and find the key drivers of the risks. And for these key drivers, you need some control measure here, and the goal should always be to have the less as possible controls, but the most effective controls in place. You simply have to capture information, loss and business risk information. You have to prepare, you have to present this information to the management board and also to others, maybe also to the outside world. Risk management is always a risk coordinating, so you always have to coordinate risk scenarios in connection with deregulation, ORSA for the insurance, ORA for the IORPS. And also on the agenda is contingency planning and crisis management. In case a loss occurs, then you have to find a solution that the business comes back to normal life again. So for this full task set, you need a lot of skills, not only mathematical skills, but a lot of other skills as well. Qualitative skills which have to do with management capabilities. You have to know about risk management, risk mapping, business continuity, about key risk indicators, quality management, information security management, and so on. You need to have a full skill set on the quantitative side, from risk capital modeling, over loss frequency and severity distribution modeling, stress testing, risk-adjusted return analysis. But these are the technical skills. You also need a lot of softer skills, especially in communication, as I mentioned already. You need to have the ability to challenge people. Risk management is also a leadership position. You have to get the people following you. You have to foster dialogues. You have to communicate in crisis. You should have a good knowledge of the company, of the market, and of the industry. You should have an easy access to people and to information. You should be agile. Project management is important. Controlling skills are important. Vigilance, change management, networking skills, all these things. So a good risk manager is able to do all these things in the same time. Of course, that's not possible that one person is able of all these things. So risk management is always best placed in a team and with a good organization within the company. There is a study of Orks and McKinsey. They called the operational risk the unloved child of risk management. Because other areas of risk management are more famous and more loved by people. It's more sexy to deal with credit risk or something else. Operational risk itself is not sexy, but it could be a major issue in bringing a company forward. And what often can be observed is that risk management focus too much or only on regulatory risk management. That means to fulfill the requirements given by regulators, and not focusing on additional topics which are important for a company. For instance, the deviation from plan values or something like that, which really is a main driver for the success of the company. And so this can be done better when involving operational risk management in a deeper way. Orks and McKinsey found some areas where there is improvement necessary. Most of the problems depend on the management information, which is suboptimal. It's not always the number of information, the amount of information which is given to the management, but it's the way of they are presented and not understandable and maybe misleading in some sense. They found advanced analytics are not integrated in an appropriate manner in the risk management offices. The controls are not effective and inefficient in some sense. Risk culture is not sufficiently embedded, so risk culture is mainly driven by some guidelines, risk policies, but higher management levels are aware of them, but staff people are often not aware of these specific guidelines because there are so many other guidelines in the company normally. So to establish a risk culture, it needs a lot of work with the people. And last but not least, the lack of business and specialists skills is always observable. Especially actuaries are, of course, a minor group of people in Europe, and there's always a lack of actuarial specialists as well. So why do we think that actuaries are relevant here? How a operational risk management organization is structured. It depends, of course, on the size of the company, on the importance relative to other risks and business focus and so on. But as I already said, we think that it's good to have teams from different disciplines, and so you need lawyers, you need mathematicians, you need business people, you need people from the techniques and so on. But we think actuaries are well positioned to have here a core, to be key people there, because of the development to become an actuary. So you have on the one hand the educational side on the mathematics. On the other hand, you have the professional side on communication, presentation, documentation, and so on. On the third side, you have the networking and the experience sharing with other professionals from the actual part all over the world, which makes actuaries very well positioned in this risk management area. AAE did a survey some years ago and found that a quarter of all actuaries is working in the risk management area in insurance, which is a high proportion. And if you look on the chief risk officers among the insurance companies, then you will find 80 to 90% of them being actuaries. So that shows that the actuaries really can play a role, and they already play some role in the risk management area. Yeah, some specific skills actuaries can bring in, which is important for risk management. Is for instance handling data and understand the limitations of handling data. So that's it sounds like an easy task, but you have to be very experienced if you want to deal with data. Actuaries have this experience. The strong quantitative skills, of course, they can be of big advantage, especially when it comes to the integration of advanced analytics, which are maybe necessary in operational risk management. And the business expertise and the communication skills of actuaries should be better than from other professions because of this professionalism aspect we have in our education and in the networking. The Risk Management Committee of the AAE prepared a paper, a folder about actuaries in risk management to promote them and explain a little bit here why actuaries are good positioned here, because they have a detailed understanding of a lot of things: economic, financial, demographic, insurance risks, statistical and financial models, financial decisions, solving complex financial problems, pricing, reserving, setting capital requirements, and so on. So there is a lot of knowledge within the actual profession, and combined with education and professionalism skills, and with the strong worldwide network, gives us a very good comfort in dealing with operational risk. So for the last 5 minutes, I want to go quickly through the appendices, which are a main part of the paper. The first is even for the regulatory part of operational risk management, to make a little bit a comparison between insurance and the pension business. On the insurance business, we have the ORSA, which is a risk management process. On the pension side, we have the ORA, which is just their own risk assessment without the solvency, because on the pension side, we have no capital requirement in the same sense as we have on the insurance side. Another difficulty for pensions is that not harmonized in Europe, because very much depending on social and labor law. So there are often very national and very local issues in pensions, whereas insurance is more or less harmonized over whole Europe, and so it's easier to give here concrete processes and concrete guidelines for doing a risk management process. So that's just to see a little bit the difference, but I guess you know in which area you are working, and you are well prepared to know what to do here. One of the main tools for the risk manager are workshops, communicative forms of coming together, because it's important not to have the only view of the actuary what could be a risk, but to have the views of a full list of people and to use the wisdom of experts. In such workshops, you aim to get a number of risks. You aim to get stories about historical losses and problems the company faced. You want to get an estimation of likelihoods, of severities, of risk ordering. You want to know about more about which mitigations do you already are already installed in the company, which are planned to be installed in the next years, who can own the risks and so on. So this is a form of communication which you need to do regularly to have a common understanding and also to get the commitment from the others about these risks. Then we have two chapters which are a little bit more technical. It's about how to quantify operational risks. We analyzed here three approaches. The one is the well-known frequency severity method, where you have a frequency distribution and a severity distribution which are modeled on their own and then combined via Monte Carlo, via Badger recursion, whatever, as one approach here. A second approach, so the frequency severity approach relies very much on historic data, so you need some data and some experience from the past. Stress testing, scenario analysis, on the other side, is relating more on future assumptions. So it's more about what can happen and what can we expect and what can we imagine what can happen, and this is more an approach with where assumptions have a higher weight than historical data. And then there is a third, it's a Bayesian approach, a causal approach, where you want to explain the causalities via contingent probabilities, and this also comes to a kind of frequency severity model, but with an equally weighted of historical data and assumptions. And so we found all these three approaches can somewhere combined as examples of the loss distribution approach, and the difference is more or less in the level of historic data versus future assumptions. We think also predictive analytics, machine learning and so on can play a bigger role in future, but of course we have to be aware that these techniques need a lot of data, and that is not always available in operational risk, therefore this question marks at the end of this sentence. Stress testing and scenario analysis, I already mentioned it, but it's important that the process behind that stress testing is very important, because so you have a three-step process at least. First you have to identify scenarios, and for this scenario identification you need again something like a workshop. In this identification, you have to bring together the people who are involved and who have to be committed. If you have a scenario setting where all the management or most of the management or other people are involved, then they have a commitment to the scenario, and then you can decide on 1, 2, 3, 4 scenarios. And then comes the next step, the quantification. That is what actually can do alone, more or less, coming to results. And then the third step, again, the interpretation. You have to discuss about the results, and then again you need a kind of workshop where you again invite all the people which are present in identification process, so that these results also are committed and transparent. And stress testing in that sense, and scenario testing in that sense, is a good way to make people aware of risks, make them committed to the risks, bring transparency in these risks. And of course you can find out risks which are not available in your data because they didn't happen in the past, but you can make them visible what can happen in future, which is more drastic than it was in the past. This is a possibility, an example of how we can describe a scenario in a good format. As I already said, these formats should not change from year to year because it's important for the manager to capture very quickly what are the main issues here, and that his eyes fall on the right number immediately, and not to have to analyze first where is written what and so on. So it has to be in a format that makes sense, and this is one example of such a format for a scenario. The main problem in operational risk often is limited data, so you have not enough data, either because it's not available or it was too costly to record them. But we think we should split in two different ways. So you have the risks of high frequency and low severity. There often the data is sufficient when recorded, and the statistical basis is rather good, so it's easy to deal with them. But on the other hand, you have the low frequency, high severity risks, which have a large impact on the financial position of a company, but with low data because they come very seldom, and it's not so easy to capture them. There you have similar applications of limited data also in insurance context, when you think on natural catastrophes or extreme events or something like that. You have a similar situation. So you can learn in operational risk management a little bit from non-life risk management, from non-life insurance. And there a technique is very common, which is called credibility theory, which tries to find a weighting between the credibility of the data and the credibility of expert judgment. So it's a weighted average of expected values of the data and expert judgment on the other hand, and according to variances and so on, you can find this credibility factor. And with ongoing experience from year to year, the data-driven results maybe will be better, but also this expert judgment can be challenged better and will improve over time. So a little bit from non-life actual techniques can be applied here. And the last appendix we have in this paper is about risk appetite limits and key risk indicators. Risk appetite is the willingness and ability of the insurers to take risk, and we see there are two ways of describing operational risk. One is the quantitative approach, where you have some solvency ratio or some percentage of the capital which can be set under risk, or a more qualitative approach, where you describe some projects, some qualitative goals, the skill set of the people, or the processes which will be implemented and something like that. And that there is a strong link between operational risk and the so-called franchise value. The franchise value comprises values like intangible assets, brands, the quality of the management, the number of people, and something like that. And it's exactly those values which are under risk with operational risk. And there is reputational risk has a big factor here, because that can destroy your brand, for instance, and cause a big loss out of that. What we also see is that it is difficult to work only with limits and to cascade the risk appetite into concrete limits that are meaningful for the business units. And we think that's better to define a lot of key risk indicators to help also in the operationalization. That could be number of complaints, that could be staff turnover ratio, or something like that. It's on the one hand a measure where you can see improvements. On the other hand, you have to operationalize the things. You have to do tools. You have to involve people in gathering this information and so on, such that there is a big awareness, and it's often more important to have this awareness about the risks than to have the concrete measure at the end. So that's a short overview of the paper. The summary is, operational risk management is the unloved child of risk management. It's not so in the main focus of the companies in insurance business, especially. But we think actuaries can help there a lot. And yes, if you have questions, then we can answer this now. Thank you very much for your attention.
Thank you, Malcolm and Christoph. So if you have questions, please also type them into the chat. And I have already some I want to share with you.
I have to find you here in the list.
I'm already here.
Oh, you, okay.
So here we go. So we have 3 questions on the list. So the first question would be, why would actuaries be good as operational risk managers? Most of the skills are typically not part of the actual syllabus. So you gave this overview of the skills required of being operational risk manager. So what's needed, or what should actuaries do to become good operational risk managers? What do you think?
Do you want me to take that, Christoph? I think that the main additional thing that is required is practical expertise, understanding of the business. So it's the challenge that arises within the actuarial profession more generally. We start off with a good technical expertise, but if you want to be successful as an actuary, you need to develop these broader, softer skills that Christoph was referring to. And these things take time, and they take exposure. So if you wanted to work in this field as an actuary, then it's good to figure out some way of navigating your career to get more of that exposure and business understanding.
Mm-hmm. Thank you, Malcolm. I think the second question is kind of related to the first. So are there, or the question is, will the actual training be extended in the future to also include more qualitative topics? What are current developments in the IAA? Does anybody of the two of you have any insights? What's going to be expected there?
We have the CIRA designation, which provides a good foundation in risk management more generally, and so there's a reasonable amount of coverage of operational risk within that space. But again,
Malcolm, you're here still?
He is muted. He has to unmute himself.
I'm unmuted. Sorry. I think you may have lost me. So just to respond to that question, there is the CIRA designation, which provides a kind of framework, but as with all actuarial training, there is a limit to the amount that you can get purely from studying. As I said earlier, it's important to get practical exposure and introduction to the topics kind of on the job, as it were.
Thank you, Malcolm. Third question is a bit specific. The question is, has predictive analytics already been used for operational risk management? I think it was one of your examples on one of the slides. Are the examples publicly available?
I don't know about public available data, but fraud detection is one of the main examples maybe here, where you also have this big data available and where you can use predictive analytics for pattern recognition and so on. So,
Excellent. So, well, thanks again, the two of you, for sharing this presentation with us. And we are perfectly in time, I would say. So then I would just directly, if you're ready, Malcolm, give the word to you, and you will give us some updates on the Solvency II risk margin paper you've prepared together with some colleagues in the risk management committee, if that's okay.
Yeah.
Okay, excellent. Then thanks a lot for the first presentation, and I will give you the presentation. Give me a second. Here we go.
Right. Okay. Can you see me and can you hear me? Yeah.
Yes.
Okay.
Everything's fine.
Okay. I just noticed that one person on the chat from the previous presentation asked if he could share the material. So I think that the paper itself, I gave you a link to where it's publicly available. So you could obviously download that paper, and the presentation, I assume, is also publicly available, but you'd need to speak to the organizers as to exactly how to get hold of the presentation material. I'm now going to talk about the Solvency II risk margin. There's another paper that's being prepared by members of the AAE's Solvency II working group. Several of the individuals also are part of the risk management committee. The paper, this particular paper, is just been signed off, but it's not yet been put into suitable AE format. So it's not actually quite ready, but I'm told that it will be available on the website, the AE's website, very shortly. Do watch out for that. But what I'm going to try and do is just to run through again some of the thoughts that we've had that are explained in the paper, but I'll try and present it in a self-contained way, since you don't have direct access to the paper yourself. So I'll provide a bit of background context, and I'll provide a few of the views that this group of individuals have prepared as part of the Solvency II working group. The Solvency II working group, I should explain, is the bit of the Actuarial Association of Europe that is particularly focused on the Solvency II related interaction with policymakers. So it's the group that is coordinating the AAE's response to, for example, the recent EIOPA 2020 review consultation paper. Got a bit of background about myself, but it's the same as the previous talk. So if I just go into the background to the paper and to the risk margin. The risk margin, as those of you familiar with the Solvency II regulatory framework will know that it's part of the insurer's technical provisions that are netted off against the assets to identify the capital base, the own funds that the insurance company has. The risk margin component is based on the concept of an exit valuation. It targets a specific approach to producing insurance liabilities, and I'll explain that shortly. And the current calculation is defined in the Solvency II delegated regulation, and it involves projecting forward the solvency capital requirement through time, discounting it to the present point in time and multiplying it by a cost of capital rates. It's based on the concept of a company needing to fund its future solvency capital requirements. It's generated quite a lot of debate and discussion amongst the industry. We'll touch on that shortly. It's also part of the call for advice that the EU Commission gave to EIOPA on the Solvency II 2020 review. They produced a consultation paper, which some of you may have looked at. It's currently out for consultation. I mentioned the Solvency II Working Group is coordinating the AE's response on that. The European Commission doesn't seem to be interested in changing the fundamental ideas and approach used to set the risk margin. They're particularly interested in how it interacts with some of the long-term guarantee measures that are also in Solvency II. But they still want EIOPA to think about the implications of the way the risk margin is set. So the sorts of issues that get airing in this space are, should we have this exit valuation approach? As I said, the EU Commission doesn't seem to be very keen to reopen that debate. But if we do want an exit valuation approach, is the cost of capital that's currently mandated, which is a flat 6% per annum throughout time, is that too high or too low? Should it vary in some way through time, maybe attenuate, be lower or higher at different points in the projection? Should you discount at the risk-free rate? And how should you do this computation of the SCR, the projected SCR that you used in the computation? So EIOPA's views, at least as expressed in the consultation paper that's out for
Malcolm, we've lost you. Perhaps you're on mute.
He's not in the system anymore.
Oops.
Yes, we can see his name, but not his audio symbol. Now he's back again, and yeah. Malcolm?
Yes, sorry, we seem to have a challenge. Can you hear me now?
Yes.
Yes.
I seem to have the internet connection has just dropped out, so
Okay.
sorry about that. So just to paint the picture, EIOPA's it's a regulatory body, but it's not unmoved by arguments that other people have come up with. Insurance Europe has argued that the risk margin is maybe too high, or even if it's not too high, it's too sensitive to things like interest rate movements. And even some regulatory bodies have questioned whether the risk margin is entirely the as currently structured, entirely appropriate. EIOPA previously advised the EU Commission that they didn't think it was appropriate to change the cost of capital rate, and in this consultation paper they're not only still proposing to retain that same cost of capital rate, but also proposing no change to the rest of the methodology. They have obviously analysed the problem, so there's a reasonable amount of material within the consultation paper, and just to highlight a few of the observations that can be drawn from that, they have looked at some exit transfers that occurred, and although you probably have to treat some of those results with caution, they didn't think there was a systematic miscalibration of the risk margin. There's quite a lot of discussion within their consultation paper on how you should or how the risk margin should ideally interact with the matching adjustment and volatility adjustment and other long-term guarantee approaches. As I said before, they seem to still be keen to, at least within the consultation paper, to use a fixed cost of capital rate. They did analyse how interest rate sensitivity varied by jurisdiction, and when they developed the cost of capital rate, they seem to prefer to focus on historic returns, historic equity risk premiums that had been observed, perhaps because they're more objectively reliable in that you can look at the data and it's there. It doesn't require so much expert judgment to look backwards. So our own views, just to kind of like summarize, I'll explain them in more detail as we go through the presentation. We didn't ourselves think that there was any fundamental reason to adjust the underlying logic behind the risk margin, which is this exit valuation approach. We did come up with some examples where it would be desirable to attenuate the cost of capital, so that's to have it declining through time as one moves forward in the projection if risk dependencies have certain characteristics, and I'll touch on that later. And we've also looked in some detail at some of the assumptions to adopt for the reference undertaking. But maybe if I can now move on to elaborate on those topics, and you can see the kind of thinking that is being articulated by the work stream. So just to take a step back, the paper analyzes the kind of theory underlying the current approach. So why is it that you might go down this exit valuation style of approach? And in essence, the underlying theory is based on the principle that insurers can adjust their assets or liabilities without a kind of instantaneous impact on the true underlying value of the business, at least the business excluding the franchise value. And so the cost of capital approach quantifies the amount of additional capital required. The challenge that arises because if you, for certain types of risks, it's impossible to hedge them away relative to this economic net worth. So the approach assumes that you adopt a minimum risk position, you hold just 100% of your regulatory minimum required capital, and that the reference undertaking that you are hypothetically transferring the liabilities to doesn't write any new business. So we didn't have any fundamental question. I mean, it's a sort of logical way of, or a theoretically sound way of putting together the risk margin in our view. But we did also highlight that there are a few other criteria that you might want a risk margin to approach to exhibit. You want it to be robust, easy to interpret so that people don't go off and do strange things, not too difficult to calculate, responding to the risks that are present, but not being unduly sensitive to factors that are relatively irrelevant or even potentially wholly irrelevant to the problem that the computation is aiming to address. So the paper tries to delve, it's aiming to provide a quite rigorous and robust analysis of the risk margin and of this current debate, in the hope that it will contribute to that debate further, assist policymakers in what seems to be quite a contentious area. But it covers 7 broad topics. I've already hinted at one, the overall magnitude and sensitivity to economic conditions, particularly interest rates. And here, it primarily is articulating the different points of view that exist without taking too strong a kind of stance. We kind of rehearse or set down some of the industry concerns, but in some cases we're skeptical about some of the arguments that are produced, and the hope is that the remainder of the paper amplifies arguments that are sound, or ones that are not necessarily quite so robust, so that can assist other people in coming to a view on these matters. So the other topics that it looks at what's happening elsewhere in the globe. The International Association of Insurance Supervisors, the new global insurance capital standard, looks at the kinds of risks that the reference undertaking should be assumed to carry, which might not necessarily be the ones that are currently written to the regulation. There's a reasonable amount on the cost of capital and the discount rates, and I'll explain why those two are pretty closely aligned. And then there's some focus on these multi-year dependencies, which we think are relevant to the cost of capital. If we're talking about an exit transfer, investors are not insensitive to how their returns are taxed. So tax is important to not to forget about. And within Solvency II, there's we have these long-term guarantee measures that arguably diverge, or some of them diverge from what you might call strict market consistency, whereas the risk margin is designed to be, in some sense, a proxy for or an attempt to be market consistent. So how do you square those two up? And there's analysis within the paper on that. So I touched on the first, the overall magnitude and sensitivity. So if we move on to the second, the interaction with the ICS, the margin over current estimate, which looks on the surface to have some similarities to the Solvency II risk margin. When the IAIS field tested their latest version of the ICS, there were 2 different alternative ways of calculating the margin over current estimate that they had proposed. One looked relatively similar to Solvency II risk margin, but with a lower cost of capital rate, and or maybe that varying according to economic conditions. And one was somewhat different. We thought that the thinking within the IAIS behind this, quote, cost of capital margin over current estimate was relevant to the Solvency II review because it's quite similar. But I'd note that the IAIS has recently come up with additional material summarizing the principles that they are planning to adopt for the ICIS. And
Malcolm, we lost.
they seem.
Okay.
Yes, I've. Can you hear me now? Okay.
Yes.
So they seem to be favouring the approach that's less similar to the Solvency II risk margin. And we also looked at other areas in international developments like the IFRS 17 risk adjustment, which might have some relationship to the risk margin. Third area we looked at was the risk coverage that should be built into the projections of the solvency capital requirement that's used within the risk margin calculation. And so here within the paper, we do analyze what sorts of characteristics it's appropriate to assume for the reference undertaking within the framework that it is endeavoring to follow. Its reference undertaking is effectively to be a shell that's writing no new business and has hedged away as much risks as possible. And here we wondered whether there was a need to think further about diversification because there will be characteristics that are present within real life transactions which might not be perfectly captured within the current wording in the delegated regulation. We looked at the nature of operational risk, which can often be quite a major contributor to the projected SCRs. Are the people who are likely to buy these books of liabilities, will they have different operational risk characteristics than the ones present in the company transferring out those liabilities? And then currently the delegated regulation assumes that all interest rate risk can be hedged, but is that really realistic? And we do look at that in a little bit of detail. Another area that we focused on was the topic of the cost of capital rate itself, the discount rates used in the computation, and these multi-year dependencies that might arise for certain sorts of risks. Worth saying that the way that you define the rate, particularly if you allow it to be varying in a predictable way through time, and the discount rates, those two are kind of like mutually linked because you can rewrite the formulae so that it's to come up with the same answer depending on how you set the cost of capital rate and or the discount rate, and that's explained in slide 17. So looking at the overall cost of capital rate first, the typical way that it is justified is along the lines of some premium that's applied to your capital base. Let's assume that it's primarily provided by equity, then multiplied by the beta of the investments that you might be holding, and multiplied by some kind of adjustment to take into account gearing. So if we look first at the equity risk premium, past data does come up with some quite punchy returns from equities, and difficult to find independent experts who are totally reliable in this space, but I think a number of commentators that we thought had some credibility hint at maybe the past is rather optimistic compared to what might happen in the future. So, for example, Norges in investment bank propose a forward-looking equity risk premium, which is a little bit lower than what we've seen in the past. The purpose of a risk margin, it is an exit transfer, so it's supposed to be, in that sense, market consistent. And market consistency is not about what happens in the past, but about what might happen in the future. So forward-looking would be ideal if we were persuaded the arguments were strong enough. So that might suggest tempering down the cost of capital a little bit. We also looked at the beta and the leverage adjustment, and here it was difficult to identify clear evidence that insurers are viewed differently to other corporates. So the paper refers to some material from Damodaran, which suggests that actually there isn't a huge difference between insurers and other corporates. These things, the statistics do seem to fluctuate with economic conditions, but they don't seem to fluctuate as much as what might be implied by the IIS's field testing cost of capital CMOCHI approach. But as we don't yet know exactly how the MOCHI will be defined in the ICS, we haven't in this paper analysed that further. What we have noticed, and there's an appendix within the paper that explores this in a bit more detail, if you have a flat cost of capital rate that doesn't vary by time, and you have risk-free discounting, so you discounted a risk-free curve, then you can come up with answers that are that contradict market consistency for certain types of policies, certain types of risks. If the risks emerge in a particular kind of way through time. And an example here is mass lapse risk within the usual way that the SCR is projected for the purpose of calculating the risk margin. You assume that only an average lapse rate has occurred up to a particular point in time when you calculate the SCR, and then the SCR in effect is stressed by the mass lapse. So the projection assumes that the mass lapse never occurs until the projection point that you're looking at for the SCR, and then it does occur. But if mass lapse does occur, then all future points in time, it's the likelihood of there being a mass lapse which is the same size as the original, based on the original balance sheet, becomes less and less. Effectively, it's impossible for more than 100% of the book to lapse starting at outset, and so mass lapse risk has this emerging property that the more has been mass lapsed up to a particular point in time, that reduces the absolute quantum of mass lapse that can occur later on in the projection period. And if you don't take that into account, as I said, you can end up with answers that contradict market consistency. They produce answers that are above upper bounds on what's feasible. And as we've note in the paper, one way of addressing that is to have the cost of capital rate attenuate through time, i.e. if it started off at 6%, being 5.9 or 5.8 at the end of the first year, 5.6 at the second year, etc., kind of cascading down through time. And as I explained earlier, you can achieve essentially the same result by increasing the discount rate, because mathematically those two have the same overall impact. We also looked at tax. Tax is clearly important for how investors view investments, but again, we couldn't persuade ourselves that there were huge differentiators between insurers and other corporates. So there are some thoughts there, but whether they produce a compellingly different answer is to what is currently present is not so clear to us. The EU Commission was quite keen that EIOPA looked at the interaction between the risk margin and the long-term guarantee measures. So the paper does explore that in a little bit more detail. Effectively, the matching adjustment and volatility adjustment assume that there is some kind of illiquidity premium available by investing in less liquid assets. Views differ as to how robust or how easy it is to calculate this illiquidity premium, or how robust it is in theory to allow for it. So the paper doesn't try to answer that broader question, but highlights that if you do believe that there is an illiquidity premium that somehow investors can capture in a kind of risk-free fashion, there are still some risks involved by investing in a portfolio that behaves and that kind of captures a matching adjustment or volatility adjustment. So you probably want to build in some of those risks within the SCR computation. And if you don't really believe that there is an illiquidity premium that can be captured in a kind of risk-free fashion, then maybe this reference undertaking wouldn't also be skeptical about the illiquidity premium, and maybe you would therefore need to assume that the portfolio was restructured to not have a matching adjustment or volatility adjustment component. UFR is another element to the long-term guarantee measures, and it can now change. So there's some thoughts within the paper as to what implications that might mean. The LTG measures also include some transitional measures, but they are essentially explicitly political. So we didn't feel it was within our mandate to express political views within the paper. I should say that we're not the only ones to be thinking hard about the risk margin. There's been a recent paper prepared by the Institute and Faculty of Actuaries risk margin working paper. So I've just highlighted a few of the thoughts that they've come up with, some of which certainly have some analogies with what is I covered in this presentation and is covered in more detail in the paper. So just to summarize, our view is that the overall design of the Solvency II risk margin is theoretically valid. It has a certain way of thinking about risks and capital needs, and it's perfectly appropriate. Not to say that there aren't other ways of doing it.
Malcolm, we've lost you again.
Yeah, I think I'm now back unmuted.
Yes, perfect.
So I think the Solvency II risk margin is we believe that it's theoretically justifiable. We found it difficult to come to a firm conclusion on whether the cost of capital rate was too high or too low within that theoretical framework, although I guess my personal view is that it's probably a little on the high side if the aim as I think it is to be forward-looking, given the point about the equity risk premium quotes puzzle as it's described in the literature. We think that if risk dependencies that are relevant to the business in question have certain characteristics, their emergence through time has certain features, then some attenuation of the cost of capital rate may be desirable. So that would be reducing through time in a predictable way in the projection. But it does, the authors differed in their experience on that. For some companies that were kind of focused on particular sorts of risks, that's maybe more relevant, but for more diversified, larger organizations, maybe it's not always so relevant. And then, as I said, we've also tried to explore, but the details are principally in this paper that should be available shortly, what kind of risks we should build into the projected SCRs, i.e. what kind of risks we should be assuming for the reference undertaking, and then how the risk margin interacts with the long-term guarantee measures. And just on that last point, I'd highlight that some of the issues that other commentators have noted with the risk margin, for example, sensitivity to interest rates, some of those are specifically considered within the long-term guarantee measures. So there is quite a lot of interaction and overlap between the risk margin and the LTG measures. The LTG measures were created and introduced to deal with some of the challenges, and therefore if there are challenges arising from the risk margin, maybe they also need to be put into that melting pot when we think about what the long-term guarantee measures should ideally look like. So thank you very much indeed, and I think that's all I wanted to cover within the presentation, and look forward to any questions that you may have.
So also thank you from my side, Malcolm, for the presentation, for the excellent and comprehensive overview. I try to take back the presentation to share the questions I've received. So here we go. The first question is, COE is currently stable over time. Should it depend on the level of interest rates? So a rather specific idea.
Yes, so this is a number of commentators have come up with this particular thought. Within the theoretical framework that I described, that dependency on the level of interest rates would be kind of driven by one's views as to whether the equity risk premium itself would go up or down as interest rates go up or down. And we thought that there probably was some linkage there, but we didn't think that it was as much as was implied by the second version of the ICS field testing margin over current estimates. So I think you probably can argue at some linkage from a theoretical perspective, but I think you need to be careful not to over focus on that, because I think investors, it isn't obvious that investors pay a vast amount of emphasis on the level of nominal interest rates when they're deciding on whether to invest in something or not. The second question, the risk margin being quite heavily dependent on the interest rate, and this can produce a lot of volatility in the economic balance sheet. So I think that this is another issue that has been highlighted by a variety of commentators. There is a question, though, which is the dependency too much or too little? I think that the kind of assumption behind how that question seems to be worded is that volatility is bad, but it might be that that volatility is just reflecting economic reality. Here, I think we get back into the area of linkage with the long-term guarantee measures, because some of those issues are deliberately designed to be dealt with by the long-term guarantee measures. So I think you can't kind of view the risk margin in isolation. Maybe there should be some further interaction with the longer-term guarantee measures. But I would just kind of highlight that volatility might not be bad of itself if it reflects the kind of the true position. So I can see that it's unfortunate to have lots of volatility if you're looking at it from an industry perspective, but looked at from a kind of regulatory perspective, the fact that things are volatile may not necessarily be fundamentally inappropriate. And here, just to pick up on that point further, suppose I had a business that was purely unit linked in nature. I would often project forward the balance sheet, assuming the assets underlying those unit linked policies was in line with the market rates, so a market consistent rate. So effectively, you project them forward at the risk-free rate, and then you discount them at the risk-free rate in the risk margin calculation. So the risk margin for that type of business would be pretty insensitive to interest rates, nominal interest rates. The risk margin is quite sensitive to nominal interest rates if you have guarantees, guaranteed policy levels, etc. But these are exactly the kinds of challenges that the long-term guarantees and political debates around them were meant to address. And then I think you've highlighted a third question, which is, should the risk margin be country specific? And I think that the hypothetical kind of theoretical basis of the risk margin is said as a transfer of the liabilities to a third party.
There was one correction. So the question is not the risk margin, but the cost of capital with it. So it is not the risk margin, but the cost of capital rate.
Okay, so so the cost of capital, should it be country specific? Well, I suppose that depends on whether you believe that the transferring undertaking, the reference undertaking, will be country specific. And I guess within the EU, free movement of labour and of capital, etc. I think it's not so clear why you would expect why it should be country specific, since it could be moved to any country within the EU. But a good question, not one that I'd specifically expected to come up.
Okay, so thank you for sharing the result of the paper and also giving the answers to the questions. As there are no further questions, I would then go to the last presentation, the last 30 minutes, and share with you some updates on the current discussion on the macroprudential framework. So, as you might be aware, the macroprudential framework is currently also part of EIOPA's Solvency II review for 2020, and this means especially that this is quite heavily well, depending on all the other requirements coming from the LTG and further reviews. Important at that point is that EIOPA always says reviews are an evolution, not a revolution, and that's something I want to discuss with you today. Is the macroprudential framework, is it just really only an evolution, or might it not be really a revolution? And when I first read about the macroprudential framework, I had the idea of, well, you might know the book from Hawkins, A Brief History of Time, where he considers a concept of different universes. How do universes behave? Is it rather a contracting universe that collapses again after the Big Bang, or is it more a static universe, a converging universe, or will it be expanding universe? And when I saw all these Solvency II reviews coming every second year, you get a new update and a new review of Solvency II, including some macroprudential frameworks. The question really is, where are we with Solvency II as a universe in that sense? Is it expanding, or, well, hopefully not collapsing? And that's something I want to discuss today with you. But to start, before we discuss what's Solvency II, the question is, what is macroprudential? When we see macroprudential frameworks as proposed, for instance, for EIOPA, the idea is to manage systemic risks, and that especially means that you want to avoid disruption of the financial systems, and then thereof serious negative consequences for the markets and the real economy. So if you avoid these, it's called financial stability. So you avoid build-up of systemic risks, and to do so, the idea is to build this macroprudential regulation. So regulators who want to prevent this build-up of systemic risk, and then in the end provide financial stability and then also economic growth, will do so by providing regulation on well, consistent with the macroprudential framework. In contrast to that is what we up to now see with Solvency II. Solvency II is not a macroprudential framework, it's a microprudential framework. That means it's not concerning with the total market, the total financial internal market or real market or economy. It's really focusing on a single company, and then for this company it tackles to avoid potential distress, or in the end also to ensure policyholder protection from this entity. So how would this then fit to Solvency II? And the question is, in the end, we see, when you look to the past, we see a lot of events where especially banks had been relevant for systemic crisis. It started, or the first big event was 1929 with the Wall Street crash. In the end, it meant something like $30 billion loss within a few months. Then there was 1984 failure of Continental Illinois, a big bank actually defaulting because they didn't do a proper due diligence during an acquisition, leading then to a big loss of the company. Then mid-80s till end 80s, also in the US, savings and loans crisis. In the end, really meaning that a third of the US institutions defaulted, and was a loss of $160 billion. And the main reason for it was that the interest rates just raised from 9.5 to 12%, meaning that there was a mismatch between the provided loans and the development in the capital market. And obviously, what we all experienced is 2007 and 2008, the financial crisis, and the problems we saw there in the capital market, especially concerning credit risks again and special structures of credit risk papers like the CDOs. What we also saw then in 2007 and 2008 was some of the insurance companies, namely especially AIG, they built up as an insurer also credit risk exposure, and there was then a direct link between insurance and banking. And so this was then part of a study done by the European Systemic Risk Board in 2015, where they saw also generally for the European insurance sector a rather big exposure to long-term interest rate risks under the two topics, low for long, so when interest rates are really getting lower and lower and staying lower for longer. So perhaps currently it's not just low for long, it's lower for longer. And then also topics like double hits. So if it's not just low interest rates, but also then connected with other events like natural catastrophes or developments in the longevity, especially for annuity products. So there are situations, there are events or scenarios where you can imagine that also for insurance, insurance companies or the insurance sector might become systemically relevant. And that's the reason why it was actually requested by the European Commission to also look into systemic risks and include that in a certain framework. And what is quite clear is, that was also the idea, it should be avoided that there's an arbitrage between banks and insurance companies. So AIG had less requirements running certain credit risks. So this should be avoided, that insurance companies have a certain advantage with less requirements when it comes to regulation. On the other hand, and that's also quite obvious, insurance companies are different to banks, because insurance companies do hold long-term investments because they have to build and find consistent solutions and assets for their liabilities. And the book is completely different to typically what banks have in their books. So as it was requested from the European Commission to analyze and then also make a proposal for a macroprudential framework, EIOPA took a route and took 3 steps to take this analysis. And I can really, for all of the audience who is interested in digging deeper in these topics, it's really good to read the papers provided by EIOPA. So it's a series of 3 papers. The first is on, well, how insurance can create or amplify systemic risks. That was in 2018. Then there was a second paper, what kind of tools are already existing in the Solvency II framework and how can they already contribute to mitigate the sources of systemic risks. And then finally, the question was, are there additional tools needed? And how should they be promoted or implemented? So this series of papers was in the end the basis for the analysis and then also for the discussion we are currently having on the Solvency II review till 2020. Let's go step by step through the analysis done by EIOPA. So obviously is actually the beginning of all the troubles also when it comes to systemic risks is actually a micropotential topic. So after a triggering event, what you see to the very left, the company might run into problems. And then at that step, it's still micropotential, or it's still part of Solvency II. But this issue or this problem might then lead to further problems. So it might be a direct impact on the entity-based sources, insurance, so that the insurance, for instance, fails, there's a default, and then that this default might lead to further reactions in the capital market and influence other companies. That might be a direct impact of a micropotential issue triggering from from an event. It might also but happen when you go to the lower branch that the company acts in a certain way, so there are company reactions, and these reactions then trigger certain events, and this then might lead to a systemic issue in the capital market. So let's look at the tools that are already existing. In Solvency II, actually, like tools like systemic adjustments, volatility adjustment, matching adjustments, they are really designed to avoid exactly this this effect of companies acting in a certain way and consistently in the whole market, and then eventually perhaps producing a systemic risk for the whole capital market. So volatility adjustments, matching adjustment should exactly avoid companies acting on short term. So they should, as their liabilities are long term, they should also look into their investments on long term and not act on very short term intensivized issues in the capital market. Therefore, the idea is really to avoid a collective behavior in the companies in the insurance market. Another possibility is the extension of recovery periods. Again, that companies don't have or don't show a collective behavior after certain events. So companies have more time, longer time to recover if that's allowed by the regulators. And then in the end, it would mean that you don't have a very vast and big impact on short time. And this also might then reduce the effects of systemic risks. And then obviously you have the transition measures we just mentioned before. All of these topics on this page, well, obviously reduce the systemic risk. On the other hand, they also reduce the reserves. And that might lead actually to an increase by itself on the systemic risks. And that's one of the questions also EIOPA asked in the review. Is it really helpful, or does it really lead to the right solution when you provide volatility adjustment, matching adjustments, and the transition measures? You might reduce the collective behavior of companies, but then on the other hand, you might increase the risk of under-reserving. Then you have further tools, not directly part of Solvency II. You have the possibilities, especially for what it's called packaged retail and insurance-based investment products, PRIPS, that under certain situations you might restrict the possibilities of consumers to lapse on these products. Again, that would reduce the problem of well, quick reactions of companies on these lapsations, and then also avoid certain risk of systemic risk for the capital market. And also then, but just after the breach of an SCR, regulators are able to, well, to take certain controls over companies, and again avoid systemic risks coming from a breach of the SCR. So the question is then, in the end, as we've seen, it's perhaps not enough. EIOPA came up with a rather long list of topics that need to be considered, or what they think need to be considered as further tools. And what you see on this list is actually grouped by two areas. The one is enhanced reporting and monitoring, so get more transparency on the topic, have more transparency also for the regulator, and be able to act better on certain situations. And the second area is to increase the intervention powers of the regulators themselves, not just getting more transparency, but also being able to act proactively. On this list, what you see in bold is the exact request from the European Commission. So the European Commission really asked explicitly EIOPA to think of additional reporting on liquidity risk, on enhancements of the prudent person principle or of the ORSA, and then also how to include liquidity risk management plans or systemic risk management plans. EIOPA even, well, had a more comprehensive or more extensive look on the topics, and they also included everything that's underlined. So they also include enhanced monitoring against market-wide under-reserving. There are inclusions of further recovery plans or resolution plans, and then they're also providing or proposing certain additional intervention powers like capital surcharge for systemic risks, temporary freeze on redemption rights, or concentration thresholds. So this was not directly requested from EIOPA, but from the European Commission, but EIOPA nevertheless considers this now for the consultation we are currently reviewing, for the consultation we are currently providing feedback to EIOPA. So let's go very briefly to these different topics that you have an idea, and I'd also like to give you a current, which is not yet final, but a current statement of some of the actuaries working on these papers. We will have to come back with our response to EIOPA till mid of January. So it's not really finalized, but you get an idea of what the current discussion is going on. So let's start with capital and reserving based tools. The first proposal is that the NSAs should be granted with the power to require what they say non-permanent capital surcharge for systemic risks, depending on certain situations. So in the end, what that means is that a regulator can add some requirements on the SCR simply based on the analysis of the systemic risk of a certain company. What we see here especially is a problem of not really being able to manage or to calculate in a quantitative way this capital add-on. Typically, and that's the basis of the normal calculations of the Pillar 1, you would really want to be able to quantitatively analyze the risks and then really have a risk-based quantification of the SCR. For systemic risks, it's really even harder than for the first discussion we had today for operational risks. For systemic risk, it's even harder to really quantify what are the risks. So it might feel a bit arbitrary, and we also fear that it might be really heterogeneously adapted or applied in Europe, then in the end perhaps leading to a not consistent view on these risks in the different European countries, and then also for increasing the heterogeneously of the European market. Second topic that's brought up here is monitoring against market-wide under-reserving. I said before, it was one of the concerns of EIOPA that especially the tools already existing, being the VA, the MA, and then also the transitional measures, that they to a certain extent already lead to a potential under-reserving. But EIOPA wanted to be able to really analyze and detect these under-reservings more comprehensively. So what they currently discuss or propose is to enhance the reporting, and based on this additional or extended reporting, it should be possible to see, based on, for instance, analysis of actual or expected ratios, what kind of sources might be under-reserved, for instance, mortality rates or incidence rates for morbidity. Are there certain reasons for certain under-reserving, and to be able to detect it very early on. The problem at that point is what we experienced in the past when there was certain under-reserving, for instance, in the US in the mid-90s for the disability income products there, or for long-term care. Then 2010 in the US market, the analysis has been done quite extensively in the markets, and there was also a certain monitoring, but just looking on the data, on the numbers, wasn't sufficient. So you need further qualitative aspects to really understand the risks and really be able to interpret the development in the market. And just analyzing the data might not really be an early indicator for under reserving. An early indicator might be really, well, when you discuss with actuaries and to see their view on certain risks. So in the end, it might lead in the right direction. However, it's very well, it's very cumbersome to fill in these additional reporting requirements, and it's very hard to really be able to have a comparable view on the different products in the European market. So we see it a bit limited what's really possible with these products, with these additional reportings. Second area is liquidity-based tools. Again, one of the ideas is to be able to get early on an indicator if there are certain risks of liquidity stresses, and then be able to act accordingly. So EIOPA's proposal would be to enhance the reporting framework and include additional KPIs, especially for certain insurance companies, not for all, but especially for the systemic relevant, for instance. The problem really is that you need to consider proportionality in these requirements. So it's really important that it's not simply a task every company has to do. It should really lead to a better understanding of the risks, and so it shouldn't be just a formal exercise. So that's very important at that point. So again, I think it's important to not just do the reporting requirements, but also better understand what's the aim for monitoring these risks, and then also be able to understand and interpret certain results to really be able to act early on. And there, I think some work still needs to be done on the side of the regulators. What we already saw before for the PRIPS products is here set up in a more general framework, the idea of a temporary freeze of redemption rights. So EIOPA's proposal is really to empower NSAs to really impose a temporary freeze. And I think that's really a good way of managing these short-term risks, especially for situations where, for instance, interest rates raise quite quickly, and that might lead to a shift from insurance products to banking products, for instance, to avoid a quick movement of consumers from insurance to banking. That could really reduce the risks for insurance companies, and also make these risks be better manageable. Then we have a whole bunch of exposure-based tools. That means tools to reduce certain concentrations of risks. The first area is the prudent person principle, which already exists under Solvency II, but then only with a focus on certain companies. The question is, should that also be extended to the relevant persons, that they not just should consider their own company, but also the whole insurance market. And what we think is it might be quite difficult to really give this person who should be discouraged, for instance, to excessively include certain products or activities, when they should not just consider their own company, but then the whole market, the whole country, or the whole European market. That might, in some sense, really be overdoing it and even stretch the capabilities of these persons. So I think that's also something that needs to be developed and analyzed a bit more to really be effective in the end. Then also in that direction is the question of, should there be certain concentration thresholds? So the idea is, should there be certain limits, for instance, for, say, corporate bonds or equity investments? When this analysis has been done, it was quite clear that the European markets are very diverse. So there's it's not really easy to set a certain concentration threshold for whole Europe, as the strategies in different countries are very different. So EIOPA at least proposes to have a soft concentration threshold. That means that it's only if it's above a certain threshold, you need to report it, but it's not a real limit. Again, the problem is it doesn't really help as the European markets are so diverse and so different. These thresholds might not really be helpful as the strategies, the asset allocations in the different markets are so different. So again, I think that's something we could consider for the future, but it won't help for the next 5 to 10 years to reduce systemic risks. An extension would be the ORSA. Currently, it's the O especially stands for Own Risk and Solvency Assessments. The question is, in that case, if the O should be extended to also include systemic risks. And again, as for the prudent person principle, it's really difficult to make risk managers also not just include their own company, but then also the whole market, to give this overview, this transparency. Secondly, EIOPA also considers to more standardize the ORSA. Again, that's problematic because the ORSA as itself should really be not standardized, but really reflect the own risks. So it will be difficult. That's something we need to see in the future, how EIOPA will manage that to achieve both a real relevant ORSA for this certain company, and then also get aspects on a European level on this report, and then bring these two things together. For me, it seems to be rather difficult to bring these two areas, these two perspectives into this single ORSA without losing quality in the report and not becoming too formal. Last but not least, it's on the topic preemptive planning. That means just already before something happens, like before a company needs to recover, before a company needs to plan its runoff, the companies need to build plans of what they want to do if this happens. And I have the impression, especially for recovery plans, that could be helpful because it's not that remote. At least for some companies, it might be realistic to already consider early on. So what might happen if we drop below 80% Solvency II ratios? But to already now consider resolution plans, that might be very, very extreme events, and I think it's not really relevant and might be a really formal exercise to already now consider resolution plans without even being able to understand what kind of scenarios might lead to these extreme scenarios. The same is true for systemic risk management plans and liquidity risk management plans. Again, it should be, it is important to avoid formal exercises and really look into the topic. It should be proportional for the companies, and not every company should have this additional burden of having additional reportings without any further benefits for their own management. That's also more or less the summary and the assessment what we provide there. So all in all, when I need to sum it up, well, we are obviously or the target really is for EIOPA to find a stable Solvency II universe. So it should be stabilized. It should not be extended to and increased over time. So that's also the statement from EIOPA. On the other hand, and that's what we currently observe, we see a certain tendency of an overload, especially when it comes to reporting, and this should be really avoided. Otherwise, especially smaller companies, they won't be able to manage and cope with these additional requirements, and they will just do it as a formal exercise without being able to see the benefits of these additional reportings. Secondly, especially when it comes to capital add-ons, it's really difficult to avoid double counting of capital requirements, and we should still be focusing on this 99.5 percentile, and not try to get higher percentiles, 99.9 or similar percentiles for the solvency ratio by just adding additional buffers. And last but not least, what we see is that, especially when it comes to systemic risks, it's still very difficult to have a consistent view on these risks in Europe, as the markets are still very different, and especially when it comes to asset risks, it's difficult, as these markets use different strategies and have different perspectives on certain instruments, and there's a certain risk that we lose consistency in Europe by adding additional requirements. So these additional requirements should really be used to increase consistency and not to have again more differences in these frameworks. So looking at the time, I am just in time till 12 o'clock. Are there any questions?
There is one question that you can see on your screen right now.
Mm-hmm. I think that's one of the problem really is when speaking of OTC operations, as typically OTC operations are not happening in a deep and liquid market. They won't be available in these environments where you have actually when you are in a stress situation. So when you need to rely on these OTC operations, that's my personal opinion, you might run into problems in these special situations, as they're not available, and then you might not be able to hedge your risks. So indeed, that's one of the topics that have to be analyzed. Are there any further questions? If not, I think as we are just well, or we have even, well, it's later than 12 o'clock. Thank you all for joining this webinar, and I hope you enjoyed it. I'm looking forward to your feedback. So as it was the first seminar or webinar we did at the Risk Management Committee, I think there's still a lot to be improved, and therefore I'm really happy to get your feedback and suggestions for improvements. And then I'm looking forward to hearing you or having you in our next webinar somewhere next year. So looking forward to that, and wish you a good day for today, and well, Merry Christmas, as I may also already say in beginning of December. So thanks for joining, and bye.